Gold is sitting at over $4,000 an ounce. Silver just crossed 67, and the most sober, most credentialed, most conservative monetary economists on the planet are quietly using a word they have never used before. That word is inevitable, the weight of the unthinkable. There is a word circulating right now in the quieter corridors of monetary power, not in the press releases, not in the carefully managed quarterly statements that institutional economists craft for public consumption, not in the rehearsed testimony before legislative committees where every syllable is pre-approved by communications departments. The word is circulating in the marginal notes of research papers written for audiences of central bankers. It is in the footnotes that most readers skip. It is in the conversations held after the formal sessions end when the recorders are off and the title badges have been removed, and the people who actually understand the machinery of global finance speak to each other with the honesty that professional survival rarely permits in public. The word is unthinkable, and what they are calling unthinkable with a mixture of reluctant awe and barely concealed alarm is the possibility that gold and silver, the metals that the modern financial establishment spent 5 decades systematically marginalizing, underweighting and institutionally dismissing, are standing at the threshold of a revaluation so sweeping, so structurally total, that it would reorganize the hierarchy of the entire modern financial world. They're calling it unthinkable. And history, which keeps better records than any of us and carries considerably more patience than the markets, has a very specific answer for the people who call inevitable things unthinkable. History says watch. Before we go any further, I want to spend a moment with that word because I think it is one of the most important words in the vocabulary of genuine financial transformation. Every truly significant shift in the monetary order, every revaluation, every paradigm collapsed, every moment when the foundations moved and a new reality settled into place was called unthinkable by precisely the people who had built their careers, their reputations, and their mathematical models on the assumption that the existing order was permanent. It was unthinkable that the British pound would surrender its role as the world's reserve currency. Then it did. It was unthinkable that the United States would simply walk away from its international gold obligations abruptly, unilaterally, without warning. Then on the evening of August 15th, 1971 on television and did exactly that. It was unthinkable that the largest, most venerable investment banks in the world, institutions with 150 years of history and the full confidence of global capital markets, could fail in the span of a few weeks. Then September of 2008 arrived, and several of them did precisely that, while others came within hours of the same fate. The word unthinkable is not a description of what cannot happen. It is a description of what the people with the most to lose from a particular outcome most desperately need to believe cannot happen. And it is therefore, if you understand how to read it correctly, one of the most reliable leading indicators available to the investor who is paying genuinely honest attention. What is about to happen to gold and silver is unthinkable to the people who constructed their intellectual lives on the assumption that the post-1971 fiat currency system, the dollar-dominated global reserve architecture, the debt-fueled expansion that has been running continuously and with increasing velocity since Nixon closed the gold window, is a permanent feature of the landscape rather than a historical episode with a beginning and therefore an end. Those people are not foolish, they are not dishonest, they are simply, and this is perhaps the most tragic version of being wrong, too invested in the world as it exists to see clearly the world as it is becoming. You are watching this, which means you are not in that position. And that difference, the difference between seeing clearly and seeing what institutional comfort requires you to see, is about to matter more than it has mattered at any point in the last 50 years. Let me take you to a conversation. A quiet office in Zurich, Switzerland in the early years of the century. A conversation that, had it been widely reported at the time, would have seemed eccentric at best and mildly alarmist at worst. But that now, viewed from where we stand in June of 2026, describes with almost uncomfortable precision the world we are actually living in. The conversation was between two economists. One of them, a former official at the Bank for International Settlements, the institution that functions as the central bank of central banks, the apex of the global monetary hierarchy. The other, a private researcher who had spent more than 2 decades studying the long cycles of monetary history with the patient, unglamorous discipline that most people in finance lacked the temperament to sustain. What they discussed in that quiet office over what I imagine were 2 cups of very good Swiss coffee was a scenario that both of them agreed was not merely possible, but on the basis of the historical patterns they had spent their careers mapping, essentially inevitable. A moment when the accumulated contradictions of the post-1971 experiment, the debt, the monetary expansion, the systematic suppression of interest rates, the growing and increasingly grotesque disconnect between financial claims and real productive capacity, reached a breaking point from which the only exits were either a deflationary collapse of historic magnitude or an inflationary revaluation of real assets that would leave precious metals at the center of whatever monetary order emerged from the wreckage. Neither of those men published that conversation. It remained in the category of things that serious people understand, but prudent people do not say aloud. But in the 20 years since, the conditions they described have not eased. They have not been managed away by clever policy or resolved by the natural corrective mechanisms of a functioning market. They have intensified. The debt has grown to levels that would have seemed like satire to any economist trained before. The monetary expansion that followed 2008 and then exploded again in 2020 went beyond anything those two men had modeled. The suppression of interest rates reached levels, actual negative real rates across much of the developed world. That would have seemed like science fiction in any economics classroom before the turn of the century. And now in the middle of 2026, the contradictions they identified are not approaching a breaking point. They are at one. Here's what that looks like in actual numbers, because this is a conversation that deserves data, not just atmosphere. Gold is trading at approximately $42 to $200 per ounce as we record this, up more than 23% from a year ago. Silver is trading near $67 per ounce, having risen over 84% in the last 12 months alone. Those are not the numbers of a quiet market. Those are the numbers of a market in the early stages of a structural repricing. And yet, and this is the part that should hold your attention, the analysts who understand the full picture are not saying the move is over. They are saying with increasing conviction and decreasing willingness to be privately diplomatic about it, that has barely begun. JP Morgan has published a price target for gold of $6, $300 by the end of this year. Bank is at $6,000. UBS and Societe Generale are at $620 and $6,000 respectively. These are not the projections of fringe analysts operating outside the mainstream. These are the house views of the largest and most carefully credentialed financial institutions on the planet. When JP Morgan and Deutsche Bank are calling for gold to approach double its current price within months, the word unthinkable has quietly left the building. But I want you to understand something that the price targets alone do not capture. The forces that are driving this are not temporary. They are not the product of a particular geopolitical moment or a short-term imbalance in supply and demand that will self-correct when conditions normalize. What we are witnessing is the convergence of multiple structural forces, each of them substantial on its own, each of them accelerating, and each of them pointing in the same direction. And the investor who understands why not just what is positioned very differently from the investor who merely observes the price movement and tries to time the trade. The first of these structural forces is central bank behavior, and it is worth spending some time here because the data is extraordinary and its implications have not yet been fully absorbed by the broader investment community. Central banks around the world added over 100 tons of gold to their reserves in 2025. That was the third consecutive year above 1,000 tons, and it extended what is now recognized as the strongest sovereign gold accumulation cycle since 19. In the first quarter of 2026 alone, central banks purchased 244 additional tons, running above the 5-year quarterly average, even as the price continued to rise. Let me put that in perspective for you. Sovereign buyers are not price sensitive in the normal sense. They are buying gold as policy, not as a trade. They are buying it because the lesson delivered in February of 2022, when the United States and its allies froze approximately $300 billion in Russian central bank assets overnight, is a lesson that every monetary authority on earth absorbed immediately and has been acting on ever since. The message was unmistakable. Dollar-dominated reserves can be weaponized. They can disappear at the stroke of a political decision. Gold cannot be frozen. Gold cannot be sanctioned. Gold does not belong to any government and cannot be confiscated by any other government's choice. For nations navigating a world of rising geopolitical friction and multipolar competition, that property, call it monetary sovereignty, has become not a preference, but a necessity. 68% of central banks surveyed by the World Gold Council in early 2026 said they plan to increase gold holdings further this year. BRICS plus nations now hold 17, 4% of global gold reserves. up from just 11.2%, 2%, 2%, and 20. And in a development that deserves far more attention than it is received, central bank gold reserves have for the first time exceeded foreign holdings of U.S. Treasury bonds in total value, with official gold holdings reaching an estimated 52 trillion against 3. 7 to 4 trillion in U.S. government bonds held by foreign monetary authorities. Gold has surpassed U.S. Treasuries as the world's preferred reserve asset. That is not a prediction. That is the reported present tense. And if you are wondering whether that matters, consider that the entire architectural logic of the post-97 system rested on the assumption that U.S. Treasury bonds were the unchallenged safe haven asset of global finance. That assumption is being retired quietly and without ceremony by the very institutions that once sustained it. If you are watching this and you feel the particular feeling of a person who has been right about something important for a long time and is now watching the world slowly, reluctantly catch up with what you already understood, I want you to hit that subscribe button right now, because what we are about to discuss in the second part of this conversation is going to deepen that understanding in ways that I believe will matter profoundly for every decision you make in the months ahead. The institutions are moving, the data is shifting, the thesis you have been holding is not fringe analysis, it is forward analysis. And we are just getting started, the confluence of forces. There is a concept in the study of economic history that deserves to be more widely understood. And I want to introduce it here before we go further, because it gives shape to everything else we're about to discuss. The concept is confluence, not a single cause producing a single effect, not a linear chain of events where A leads to B and B produces C, but the simultaneous convergence of multiple independent forces, each of which would be significant on its own. All of them arriving at the same point at the same time and producing an outcome that none of them alone could generate. Monetary systems do not change because of a single cause. They change when enough forces converge at once that the existing order lacks the capacity to absorb them all. We are at such a moment, and the metals that are positioned to benefit from it are for reasons both ancient and remarkably contemporary. Gold and silver. We have established the central bank dimension. Let us now add the dollar's structural challenge, because it is not separate from the central bank story. It is in fact the same story viewed from a different angle. The dollarization of global trade is no longer a geopolitical theory or an academic projection. It is a measurable, documented, ongoing reality. The dollar's share of global reserves has fallen approximately 14% since 2002, with a decline accelerating meaningfully after 20. Bilateral trade agreements conducted in non-dollar currencies are multiplying. Nations that once held U.S. Treasury bonds as their primary reserve are diversifying with increasing urgency. And the reason, as we noted in the first part of this conversation, is not abstract anti-American sentiment. It is the entirely rational calculation of sovereign institutions that have watched one government's foreign exchange reserves disappear in an afternoon and concluded that their own dollar-denominated reserves carry a risk that was not visible in the pre-2020 world. When the incentive to find an alternative becomes existential rather than merely economic, when the question shifts from should we diversify to what happens to us if we don't, the pace of diversification accelerates dramatically. And the alternative that every monetary system in history has ultimately returned to when the paper alternatives failed is gold, because gold is the only major reserve asset that does not carry a counterparty. The only asset that does not require you to trust another government's goodwill or another institution's sovereignty. The only monetary instrument that has maintained its essential character across 6 zillion years of human commerce without the intervention of any political authority. Now, I want to turn to silver, and I want to do it with the attention it deserves, because I think silver's specific situation in 2026 is actually more unusual and more potentially explosive than even gold's. And that is saying something. What makes silver distinctive right now is that it is being pulled simultaneously by 2 entirely separate sets of forces that are both accelerating and both structurally real. The first is the monetary force. Everything we've been discussing, the dollarization, the institutional reassessment of paper assets, the movement toward hard assets that cannot be manufactured by a central bank's decision. Silver participates in all of that. It always has. In every monetary crisis in history, silver moved in the same direction as gold, though often with more volatility and ultimately more magnitude. The second force is industrial demand, and this is where silver's situation becomes genuinely remarkable. The global transition to clean energy is not an environmental aspiration. It is one of the largest industrial mobilizations in recorded human history. The International Energy Agency has projected that meeting global climate targets will require the installation of solar capacity that is multiples of anything installed to date. Every solar panel requires silver not as a luxury component that can be engineered out at sufficient cost pressure. Silver is embedded in the photovoltaic cells that make the conversion of sunlight to electricity possible at the efficiencies that modern panels achieve. It is in the electrical contacts. It is in the components that nobody outside the industry talks about, but without which the panels simply do not function. At the same time, the global electric vehicle fleet is expanding at a pace that requires silver in quantities that supply chain analysts are only beginning to fully reckon with. Every EV contains more silver than the internal combustion vehicle it replaces. Medical technology, advanced semiconductor manufacturing, the 5G infrastructure being built simultaneously across dozens of countries, water purification at industrial scale. Each of these demand streams is real. Each of them is growing, and they compound on each other in ways that make the aggregate demand picture for silver unlike anything the market has priced. The supply side of this picture is not keeping pace. Silver mining is not expanding at anywhere near the rate required to meet the combined monetary and industrial demand. The Silver Institute has documented a structural supply deficit in the physical silver market that has now run for 6 consecutive years as of 20. Not a temporary imbalance, not a one-year anomaly that a higher price will quickly correct. A persistent deepening structural deficit that reflects the fundamental mismatch between a world that is consuming silver at accelerating rates in a mining industry that has not made the capital investments necessary to materially expand production. When a market has a structural supply deficit and an accelerating demand picture, the price adjustment is not a question of if, it is a question of when and of how large. And the honest answer based on the data we have is that the when is now and the how large is larger than current prices reflect silver has risen over 84% in the last 12 months as of this recording. That sounds like a lot until you consider that silver began the year 2026 near $71, reached as high as $115 per ounce in January, and has since pulled back to approximately $67. The volatility is real. Silver's character has always included volatility, and anyone who holds it needs to understand and accept that character. But the structural story, the deficit, the industrial demand, the monetary participation has not changed. If anything, it has deepened. The pullback from January's highs is not the end of the story. For the investor with the appropriate time horizon, it may be among the most significant buying opportunities of the decade. I want to introduce a name here that I think deserves more attention than the mainstream financial press has generally given it. Because this person's argument, which was considered eccentric for most of her professional career, is now being treated with a seriousness in serious rooms that it was denied for decades. The name is Judy Shelton. She was nominated to the Federal Reserve Board of Governors.